All right, I think we can get started now. Quite a few people on this one. Apparently people want to talk about hedging grain, which is a good conversation to have given the chaos we've been having in these grain markets the past year or so, 2 years. So anyway, I'm Scott Anderson, the founder of Cash Cow Farmer, and today we're going to talk about 4 futures and option strategies to hedge grain that you have stored on the farm. If anybody has any questions, you can type them into the chat box on Meerkat, Periscope, or we also have a chat box on the sweetfishmedia.com/cash cow farmer -live -webinar website. So any questions, just holler at me. I'm more than happy to answer questions. So getting right into it, when we're thinking about hedging stored grain, there's a lot of things that we gotta think about. And mainly our production costs and our profitability is one of those things. And knowing your production costs for corn, soybeans, wheat, sorghum, whatever you're growing is extremely important. And that is kind of the bottom line of Cash Cow Farmers, to set the farmer up with a really easy to use tool and system to manage their production costs. You'll know what your cost of production is for every bushel of corn on every field that you grow. You'll know how many bushels that you've got left to market after you've made some marketing contracts. I mean, having that information handy and available to you is extremely valuable in making good marketing decisions. So Cash Cow Farmer, it's free to check out. Go to cashcowfarmer.com, check it out, and throw in some fields, put in some operating costs, and see how easy it is to use. And I'm more than happy to help you get set up and started on using that software. But very easy to use, very cheap. I mean, for small farmers, the annual expense on Cash Cow is peanuts compared to what you can lose by making bad grain marketing decisions. So make sure that you know your cost of production, because that's where your marketing plan starts. How much does it cost you to produce bushel of corn? Is it $3? What's the market right now? $3.10. So what do we want to do with our hedging strategies? Protect downside, go for upside. It's important to think about these different strategies going forward. So today we're going to go over 4 specific strategies using options and futures, and some of them may be complex. So if you have any questions, just don't hesitate to holler. I can re-explain things or do whatever helps you guys and gals. So we're going to have a 100,000 bushel hedging strategy. And we're going to break that into 4 strategies of 25,000 bushels each, and then we'll track these strategies, okay? So 4 by 25K bushels, okay? So the first strategy, and I got a lot of these strategies from reading, let's see, what's this magazine? The Top Producer magazine. Anybody read the Top Producer magazine? This one is specifically on grain marketing, and they have this really nice article with all these different marketing advisors. There's Brian Basting, Jeff Beal, Bill Biederman, Naomi Bloom, Richard Brock, Alan Brugler, Mark Gold, Randy Martinson, Angie Setzer, Bob Utterback. So here's, I don't know, 10 or so different grain marketing professionals. That's their job, is they watch the grain markets every day, and they try and figure out what's going to happen and the best ways to hedge your grain. So I work specifically with Randy Martinson, and he's with Progressive Ag. I work with a handful of these people. This is never wasted money. This is never wasted money at all signing up under any one of these services. I work with Randy Martinson specifically with Progressive Ag, and done a really excellent job with me. Never a waste of money to get advice. Never think you're wasting money by getting advice. It's very, very good program. A lot of these people are extremely smart. So it just goes over. Everybody has their little spiel on what they think is going to happen in the markets. And a lot of people had these different strategies with calls and puts and futures contracts. And so I used a lot of their examples on ways that we can hedge. Some of these 4 strategies came from from these professional grain marketing people. And so I'm going to go over each strategy, and then I'm going to switch over to my software, and I'm going to implement each strategy. So it should be interesting. The first strategy is going to be selling your cash grain. So selling 25,000 bushels the elevator and locking in that price, and then doing a vertical call, which means that you buy an in the money, an at the money call option, and you sell an out of the money call option. So I'm going to use color coordinated markers here so you know whether we're buying and selling, make it a little bit simpler. So you sell 25K of your grain, right? So that's an S. That's a red one. And the next thing you're going to do is you're basically going to sell that cash grain, and then you're going to buy back the options. So you're going to basically buy that grain back with the futures options. So you're going to buy a call, and we're going to use the 380 call for that. So we're going to use a 380 call. That's what you're going to buy back. So as if grain goes up at this point, you're going to capture some of that upside. Of course, you've got a premium with every option that you buy. So some of that upside is going to go to paying for that premium. But if it goes down, remember, you've already locked in the cash. So the only thing you can lose is that premium you pay for the call. But to help pay for that call, you're going to sell an out of the money call option. So selling an out of the money call option is going to be red here. And we're going to sell a 420 call. Okay, so that's the premium on that 420 call is going to be a lot less, which is going to help pay for that option that we bought there. So that's the first strategy. Sell the grain that you got in the bin or contract it out, lock in the price for July. And we're using July for all this. Just so everybody knows, we're using July contracts on all this stuff. Okay, so that way you hedge it through the winter and you can capture that upside over the next 6-7 months. All right, any questions, just type them in. I'll try not to miss them. So that's first strategy number one. Strategy number two. Strategy number two is going to be a covered call. So you're gonna buy a covered call, which basically means you're going to sell the futures options. You're going to sell futures contracts, 5 of them. You're just going to sell short the July futures and then buy call options. Yeah. So first thing we're going to do, we're not going to do anything with the grain in the bin at this point. So the grain is just sitting in the bin at 25,000. So we're going to sell 5 futures. And all these are in increments of 5, because each contract is for 5,000 bushels. So if we're going to do 25,000 bushels, we're going to do 5 of these contracts. So sell 5 futures short. And then the next thing we're going to do is we're going to buy 5 call options. So this is going to protect the downside. Okay, it's going to protect the downside because we've got the short options. So we're basically locked in right now at whatever price that we are. And then we capture some of that upside with the call options, because remember that grain we got in the bin is going to gain value as the price goes up, but because we're short 5 contracts, it's also going to go down. All right, we're going to lose money on paper, so that's going to offset any gain in the grain. And then the other one is going to be to buy 5 call options to capture that upside. So the next one is going to be buying puts and selling out of the money calls. And this is gonna allow us to capture the upside of 20 to 30 cents. Remember, when we're hedging grain, we're not going for dollars. We're going for dimes, and we're just basically going for 10 to 30 cents, trying to get 10 to 30 cents out of the market and trying to protect ourselves from losing any more than 20 cents or so. Last thing we want to do is lose another dollar on 100,000 bushels. That's $100,000. So remember, every penny on 100,000 bushels is $1,000. So we're trying to gain another 20 to 30,000. and we're risking, you know, 15 to 20,000. Okay, so the risk reward here, we're just hoping that the market's going to go up and trying to capture some of that upside, you know, with call options, but hedging our downside. So we want to make sure that our downside is limited at, you know, 20 cents or so. Okay, 15 cents in some of these cases, as you'll see. So we're going to buy a put. And that's at the money. Okay, buy an at the money put and sell out of the money call. All right, so the put's going to protect our downside, and we're going to sell that out of the money call to help pay for the put premium. And then, of course, we still have the grain in the bin to capture any upside. If there's a dramatic dollar increase in corn, we're going to capture a lot of that minus the difference between the put premium and the selling of the call option. So we're going to catch a lot of that upside with the grain in the bin, but we're going to hedge our downside. Our downside is going to be limited to like 15 cents in this case. So that's very, very good. The last one is just going to be simply buying puts. Okay, that's the simplest strategy, number 4. We're just going to simply buy puts. So if grain goes up, we're going to lose the premium on the puts, but at the same time, we are going to gain the upside with the grain in the bin growing in value, that 25,000 bushels there. So we're just going to do at the money puts. All right, so those are our 4 strategies. Any questions, holler at me. I'm going to switch over to my trading software, and we're gonna start executing these strategies. You know, I think the market closes in 2 minutes, so I don't know if we'll get them all executed in 2 minutes. I picked a bad day for this to hammer out because of, you know, the holiday. We got an early close today, but anyway, so I'm going to turn Meerkat and Periscope over here. So it's going to be tough to make out these numbers. I apologize for that, but you can always resort to the YouTube video for what's going on in the markets with this stuff. So anyway, this is the paper trading account in TD Ameritrade. Any questions about this, holler at me. You know, so this is the TD Ameritrade Thinkorswim platform. Download onto your computer, and right now we're going to go to the trade column. We can go to the charts. We can look at, these are the 4 charts I went over last time. We've got corn. Corn right now is down 5 cents. For the nearby contracts, down 5 cents. Next year corn, December of 16, is down 4 cents. Soybeans are down 2 cents in the nearby and down $1.75 or 1.75 cents for next year's corn. So FYI, markets are down today. So we're going to look at the active contract is March 16, but we're actually going to look at July. Okay, we're going to look at July because that's the one we want to hedge. So we'll go into the options chain here. All right, and then these will all be, when you're going in for your first time, they'll all be shut, they'll all be closed. So just go to July 16. There's 210 trading days of July 16 contract, and we'll scroll down a little bit. So these are the 14 strike prices that are at the money or very close to at the money. And what was our first strategy was to sell 25,000 bushels to the elevator of grain, and then buy an in the money call and sell out of the money call. This is called a vertical call. So what we're going to do is we're going to go over here to the calls side, and we're going to right click on the buy, and we're going to do buy, and then we're going to go to vertical. Okay, buy a vertical. And because we're hedging 25,000 bushels, we're going to do 5 contracts here, buy and sell vertical. And we're going to do the 380 call in the money, and then we're going to sell the 420. And right now our price, basically, if we execute it right now, it'd be about $12.25. That's what it would cost us to do that trade, which is 12.25 cents on a bushel of grain. Okay, so that's your maximum downside. So you have to, the market has to go up 12.25 cents for you to pay for this strategy, but anything above and beyond that is money in the bank. All right. So we are going to confirm and send that. And then it's going to pop up this dialog box. Your max profit is 6,937.50. Max loss is 3,000. So for every dollar we're risking, our potential gain is going to be, another dollar. So we're risking $1 for the potential to gain $2. And here's the cost for 5 contracts is $18.30. Very, very cheap, very, very cheap way to do it on yourself through TD Ameritrade. I really like that. So I'm just going to execute that. That one's sent out. And for some reason we got rejected. I think it's because this is, let me just see why that got rejected. Let's do it again. So we're going to right click on the buy, do a vertical. We're going to do a 420 call for 5. We're going to change from, this is the time period right here. You can either have it expire in a day or GTC, which means good till cancel. Okay. So good till cancels mean that it'll go on until it gets canceled. So okay, well, I keep getting rejected. Apparently on this fake account, I don't have futures trading enabled for some reason. I don't know why that's simulated. This is a simulated account. This isn't my actual trading account. So anyway, we will just execute the strategies. I'll go in there and execute them. The markets are going to close here very soon. So I will execute those after this is over, and then we can track them. But you will see how to execute them while I'm doing this. So remember, the first strategy, that's how you do the first strategy. It's a vertical option where you're basically buying this 380, and the last price was 23 cents. So that 380 option, $3.80 is going to cost you 23 cents. But remember, you're selling the 420 for 10 cents. So it's actually only about 12 or 13 cents that strategy is going to cost you. So you've sold your grain, you've got the cash, you got the check from the elevator because you sold the grain, or you at least contracted the grain. So you might not have the check. So you contracted the grain that you got in the bin, 25,000 bushels, and then you bought a nearby contract and sold a long contract. So remember, the way you make money on this is that you hope that corn goes up by 20 or 30 cents. That'll pay for that 12 cents that you got and then get you another dime or so. Remember, we're not trying to get dollars, we're trying to get dimes and stuff like that. So any questions, feel free to drop them in. This stuff can get confusing, so holler at me if you have any questions. If anybody has any other strategies that that want to see how to execute them, I'm more than happy to do that as well. So the next strategy, sell the futures short and buy 5 call options. All right. So we still got the grain in the bin. So what we're going to do is we're going to go up here to that July contract. We're going to right click on that and we're going to sell a single. We're going to up it to 5 contracts and we're just going to sell it at 378, whatever it is. You can do, there's a whole bunch of different ways you can execute a single buy order or sell order. In this case, a sell order. So we're selling short the futures. So anything below whatever they execute at is gonna make money in this trading account, and then anything that goes up, we're gonna obviously make money with the call option and the grain in the bin. So when you're buying a futures option, you can do a market option, which means it's just gonna execute at whatever the price is at that second you hit the send button. You can also do what they call a limit option, meaning that you set the price. So maybe you want to sell short at 380, you can put a trigger in there and then you can change that to good till canceled. So if it doesn't execute today, it'll sit there and wait until the price gets there. If it doesn't get there, of course, you're not going to ever get bought in. So let's just do a market order, confirm it, send it. Probably going to get rejected. Oh no, we got we sold. So there we go. We sold short 5 contracts there, and now we're gonna buy the at the money call. So we're gonna go here to that 380 call, and we are gonna buy. We're just gonna buy a single. We're gonna buy 5 of these guys, and we're gonna do a limit price of 48 cents. Man, those are spendy. 48 cents for one of those calls. That's why people hate buying calls, because they're expensive to open up, and then as they get closer to when those call options become active, they tend to lose value very, very fast. So we're just going to go good till canceled, confirm and send, and we're going to send that in there. Yeah, for some reason it's not letting me do call options. I don't know why, but anyway, that's how you execute it. And usually after you've opened up this account for options, it will let you do that. It must not let me do call options on the simulated trading, or options at all, which is no problem. You see how to do it, and I can track those. We can track them later on as well. So, all right, that's strategy number 2. Strategy number 3 is to buy an at the money put and sell an out of the money call, while still holding on to all our grain in the band, that 25,000 bushels we're hedging with this. So at the money put right now, we're going to sell one of these. So this is actually, you call this a combo, and then you can right click on there, go to sell a specific. It's not going to be single. It's going to be a combo. So we're selling. Oh, wait a minute. I did this wrong. We're going to go back in here, and we're going to buy a combo put here. So we're going to buy 5 at the money puts. I wonder why that. Let me switch this around here. And we're going to sell out of the money calls. So we're going to go back to that 420. We've been liking to sell that 420, and we're going to buy these puts. So basically, looking at this, we are going to sell these puts for right around 22 cents. 380 puts, 22 cents. We're going to sell those for 22 cents, and we're going to buy we're going to buy those for 22 cents, and then we're going to sell that out of the money call for right around 10 cents or so. So this is going to cost us about that 12, 13 cents, just like the first strategy. So we're going to put, what I did here is you got the buy, contract, expiration, and then the strike price is 380 on the put, and you're going to sell that same contract, but it's a call and a 420 call, out of the money call. So you confirm and send that, you send it, and then of course that executes the trade, or you set in that limit option or that limit order, which will make that trade execute once the prices are established that you set parameters around. So if you're setting limit orders, you're going to want to wait on selling that grain. If one of your parameters that you have to sell cash grain, you're going to want to wait till that executes. And then once that executes, if you're using this software, you will have a text message that you get, or an alert on your phone or on your computer. And then you'll know that you got bought in, and then you could sell that grain to the elevator in order to complete the hedging strategy. Number 4, the simplest one is number 4, which is just simply, hold on a second here, we're looking funny. Number 4, which is just simply buying the puts, okay? So going over here, 22 cents, I'm not going to do anything with the grain. I'm just going to sit on the grain, and I'm going to buy a put. That way I'm protected for the next 22 cents to downside, all right? So actually right now, 33 cents looks like the last price that this put was trading at. So you're out 33 cents if grain goes up. So if the grain market goes from 380 to $4, the maximum you'll make is, that you got to deduct 33 cents, because that put option is going to be worthless. Remember, you bought it for 33 cents. It's going to be worthless. So you're out 33 cents. So if grain goes down, that put option is going to become more valuable. If grain goes up, then that put option is going to be worthless, but you're going to capture that upside with the grain you've got in the bin that's not sold. So we're going to go down to 5 options contracts for 25,000 bushels. We're going to confirm and send that. And then of course you could lower the price if you wanted to. You said, well, that's low spendy. Let's wait till it goes to 30 cents, which at that point for this put option to lose value, corn's going to have to go up. Then the put option will lose value, or time will have to erode away. So you see that you check and make sure this, okay, break even stock price is 350, max profit is 87,000, max loss is 7,500. That's the nice thing about options is that money at risk is very low, of course, to zero. So you're never ever going to realize 87,000 in this example, because corn is not going to go to zero. But if corn goes to $3, you are going to realize a pretty significant profit on that put, and then you're going to offset that by some losses in your grain in the bin, of course. But you're limiting your downside. Remember, the goal of hedging is limiting the downside. You're not trying to be a hero and make zillions of dollars in the futures and options market. You're just trying not to lose money. Remember, the goal of any business is not lose money, of course, make money. So, and then your buying power goes down every time you do this. So remember, if you're going to hedge 100,000 bushels, you're going to want at least $100,000 in your options and futures contract margin account. Okay, so $1 per every bushel hedge is a good rule. You shouldn't have an issue with margin calls. Then, of course, if you do get a margin call, you're going to want to make sure that you're offsetting the closing of that hedge with cash sales. Okay, because the last thing you want to do is be short a futures contract, get your butt kicked by futures, rallying up, and then selling that contract at a huge loss and not offsetting that futures sale for an actual cash sale, and then the market goes back down and then you lose again with the value of the grain you got in the field or in the bin. So we're going to send that. It's going to reject us, of course, because I don't have that set up. I guess I never realized that. I don't use the simulated trading very much. This was the first time I've ever used that. So anyway, I will try and go back and execute those trades and get them to show up in here so that we can see what's going on with those. But that's how you execute those 4 strategies. So we did futures contracts, we sold options, we bought options, we did about everything there is to do with that sort of stuff. So if anybody has any questions, I'm more than happy to answer the questions. I'll just leave it open for 5 minutes or so. Again, when it comes to hedging grain, you got to know your cost of production. I mean, as a farmer, the only way we can 100% for sure make more money is by managing our costs of production, knowing which fields are going to make us money, knowing which fields are going to lose money, and going from there. So the next broadcast, I'm going to try and do one every week, and I want to follow up on all these different strategies we did to see how each one is doing as well, in the market. So I'm gonna sit here for a while and try and execute these out in this fake one. If not, I'm gonna write down the prices that we executed them all and put that in a spreadsheet, and then we'll revisit that every week and see what the prices of those options, which of those 4 strategies was the best strategy. And remember, just because it won this year, it's like a corn hybrid. You might have an awesome corn number that won the test plot, but next year it falls on its face. Every option strategy. That's why I think you need to have a lot of different option strategies and future strategies, because what may work today may not work tomorrow. So it's very important to know what strategy is going to work today and tomorrow and whatnot. So next broadcast will be sometime next week. Everybody that was on this call should get a follow-up email, and then go from there. I've been trading since I was 19, 11 years. I've been trading for 11 years, and not futures for 11 years, of course. I've been trading futures for about 5 years, but stocks and options, I've been trading equities for about 11 years, and then, futures and options on futures for about 5 years. And I do the future stuff as mostly hedging. Certainly, I do some speculative trades such as silver. I like to trade silver, and I like to trade oil and a few things like that. I definitely like to trade, the S&P 500 and the Dow Jones as well, mostly to hedge the equities that I own. So anyway, back to production costs. You got to know what your production costs are. You got to know which fields are making you and losing you money. I don't see how. I visit with so many farmers that I ask them what they're using. They call me about Cash Cow Farmer, the production management software, grain marketing software, and they ask me, okay, well, I ask them, what are you using right now? And they say, well, I'm not using anything. I'm like, well, how do you know which fields are making you money and losing you money? They go, I don't know. I don't know that. I've farmed for 20 years and I don't know which fields are making me money and losing me money year in, year out. And I'm like, I don't know how you sleep at night. Not knowing that information, man, I would just turn and roll around all night and be like, I don't know if I'm going to make money or lose money. So number one thing is you got to know what your break-even production cost is on average, and that includes everything. That includes the family Disney trip, because if you want to keep doing family Disney trips or something like that, you got to include that in your production costs. You got to add that in the overhead. When it comes to production costs, if you're a farmer and your main source of income is farming, and that's what you do to take care of your family, you got to know what your costs of production are for everything. If you gotta take home $100,000 every year to sustain your and your family's quality of life, then you got to know what price of corn I got to sell to make that happen every year. What do I got to protect with futures and options contracts and cash sales and hedge to arrive contracts to make sure that I am taking home $100,000 every year so my family's quality of life can be maintained. So anyway, any questions? More than happy to answer the questions. I'll just hang out for a few minutes with everybody, and if you have any questions, you can just shoot them in there. For those of you that want a repeat of this event, it's going to be, just go to YouTube, type in Cash Cow Farmer, one word, and you'll find our page, and then this event will be on there. And I use my computer to record the actual trading software. So for those of you that join me on Meerkat and Periscope, go back to the YouTube video and you'll have a much better viewing of what actually we're executing there. So if anybody has questions about futures and options contract strategies and whatnot, you can email me, scott@cashcowfarmer.com, and set up a time to visit with me about it. If you're interested in the tool, Cash Cow Farmer, I'm more than happy to explain that, help you walk through and implement your farming operation into Cash Cow so that you know your production costs, you know exactly how much money you're making on each field. Because, the last thing we want to do is to spend all year doing the brutal hard work of farming and walk home with nothing and pray that the government payments will help us make it through the next year. So anyway, every year I run into farmers that are making crazy amounts of money every year. Plenty of farmers making hundreds of thousands of dollars in income this year. Plenty of them. And they're the aggressive farmers. They've planned ahead. They know what's going on in every one of their fields. They're either using Cash Cow Farmer, they're using a spreadsheet, or they're using some software program to make sure that they know exactly what the costs of production are in every field they farm. They're killing it. They're spending time in the office, Spend some time in the office, sit down on the computer, crunch some numbers. That's a good return on investment. Go over your bills from your co-ops, your seed bills and chemical bills, fertilizer bills, and make sure that those are all correct. I don't know how many times I found $10,000, $20,000, $30,000 in misallocated bad billing on my co-op bills just because, I prepaid. And am I voting for Donald Trump 2016? I don't know yet. I don't know enough about all the candidates to make that decision, but yeah, so make sure you know what's going on in your operations. So we've done this. We've been on for about 36 minutes. I'll give it till another couple of minutes. And if anybody has any questions, holler them, shoot them in there and I'll answer them. But if not, just hang out there, and we'll be on the next live talk. I will go over how each one of these strategies performed over the course of the last week. I'll probably do it on Friday during the day, or I might do it on Saturday. If you have a good time, anybody out there that has like a great time to do these talks, holler at me. Let me know what time I should do these talks. I'm still not sure what time generally works out. I would think on Saturday. Saturday is usually a pretty good day for farmers in the afternoon, like 2 p.m. to go over there. Thanks, Rob. And so, Saturday afternoon, if that works for people, I'll do that. I would really appreciate some feedback on when I should do these presentations, because I do want to make sure that you guys catch them live so you can ask me any questions that you might have. So anyway, corn the nearby is down $5.50. Next year's corn, 2016, D's 2016 is down $4.50. Soybeans nearby is down $1.50. After college football on Saturday. Boy, Saturday's football all day. It seems every day. It doesn't matter where you're at. November 16, soybeans down 1.75 cents. And when I say down $1.75, I actually mean down 1.75 cents, because futures are in like 390 versus $3.90. So anyway, markets are down a little bit today. I don't think there's very big volume. Yeah, so far the volume's not very big. It's like half a normal volume, which just means that there's not a lot of activity going on. So if there's somebody out there that's got a big short, then they're going to push the markets down, because there's not enough people watching today to get in there and buy those shorts out, buy those sales, offset the sales. So low on the soybean contract is 844 right now. Low on the corn contract is 346. Soybean, the low was 844.25. Right now we're at 873.75. So we're about 30 cents, 28 cents, 20.5 cents above that low. So not a lot. Corn, 367 is what we're at right now versus 346. We're about 31 cents above that, 10% above the bottom on corn. And that is, when was the last time we were that low? Probably going to have to go, 318 in October of 14, we hit 318. So that was not a good month. Get me out of here. Yeah, boy, it's been a long time since we've seen $3 corn. Looks like last time would be the fall of 2010. No, 2009. Fall of 2009. Spring of 2009. We had corn that was right down in that 350 area. So we're at basically a 6-year low right now in the commodities. So, all right, 340. I'm going to jump off of this thing. So thanks everybody for joining. Really appreciate it. And everybody have a great weekend. Talk to you later. Bye.